Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Joann Nevruzi and Joann Spadigam. Okay, Jan, we always joke that you have the unfortunate job of having to record Bondcast on a Thursday ahead of NFPs or whatever data print there's going to be out of the US on a Friday. But never has that been more true than last week, I think. It feels like a long time ago now, but it would be very remiss of us not to discuss that payrolls report since it was seemed so pivotal for the markets that were kind of one-directional before that. So let's talk about that first. How has that kind of changed your outlook and what's your take, I guess, on that number?
Yeah, like you pointed out, without a question, it was an extremely strong payroll day. We added over 550,000 jobs last month, and the revisions for the past year showed that the economy added even more jobs than what we previously thought. That erased all of the post-Fed gains, perhaps rightfully so, as people started questioning, well, is the labor market since it's too tight, or I should say stronger than we expect, does that mean that wage pressures are not going to come down as fast as we hope? Does that mean it's going to keep fueling inflation higher and higher? That is yet to be seen, of course, but it certainly changed the tone of the Fed officials that spoke afterwards. It led to this big sell-off on the day of as rate cuts and kind of like the terminal rate got pushed higher. Rate cuts got removed. Some of the rate cuts got removed from the curve. And overall, it presented like a conflicting story of some of the data that has been showing weakness, but a labor market that remains still very strong despite, say, the drop in spending in certain categories, which you would think would naturally spill into more unemployment. We still haven't seen that. And the link between unemployment and inflation is kind of shifting a sequence, like we've previously pointed out. You're seeing wage inflation coming off from its peak, but unemployment keeps coming down as well, which you would expect to see joblessness increasing before wage pressures coming down under traditional economic theory.
How does that leave your outlook for the Fed then? You kind of have long been on a slightly more hawkish spectrum than the market and expecting Fed funds to get to a higher rate this year and not expecting them to cut. Have you revised that outlook up even further, or are you kind of waiting to see, particularly, I guess, ahead of CPI next week?
Yeah, we haven't revised it. I should say our economics team were vindicated after this jobs number, because post the Fed, market priced out possibility of cuts, but we priced in, a possibility of hikes in May. We priced in more cuts for the rest of the year. Our view going into the previous Fed and into the next one was that we will get 2 more 25 basis point hikes in March and in May, which would bring the terminal range to the 5 to 5.25 range, similar to what the Fed projected in December. We haven't changed that. Market has now fully priced it in, I should say, perhaps slightly even more than that. So it is exactly where we think Fed funds future should trade at, considering for the next few months. We haven't updated our Fed forecast in a sense that we still don't expect cuts for the remainder of the year. Whether they add or keep hiking in June is yet to be seen. I mean, if inflation doesn't really show this trend toward lower burns on a monthly basis, and if we keep adding payrolls with anything remotely as strong, then yeah, the Fed can keep hiking, of course. But so far, we're maintaining that they'll get to the 5.25 range and pause and evaluate.
And what about the Fed speak that we've had this week? You know, it's certainly not been a quiet week when it comes to central bank rhetoric all across the globe. We've had lots of Fed speakers. I guess Powell was the kind of headline speech this week. Is there anything that we've learned from them? You know, obviously all this kind of what the market perceived to be a very dovish shift by central banks came before this, whopping payrolls number. Have they changed their tone since last week, do you think? Is there anything new, any new guidance from them or not really?
So the main speaker was Chair Powell on Tuesday, where he was interviewed in Washington, and really expectations, I think, were pretty similar going to the Fed meeting. Everyone was expecting him to push back against market and say, well, listen, we have a lot more to do, and deliver this hawkish tone. I simply don't think we got that, because jobs are important, yes, but inflation is the number one priority right now, and we have an inflation print due next week. So our view was that he simply wouldn't lock himself into a position to say, well, see, we need more hikes than what was priced in, or we got to do a specific X amount more, or something along those lines. And he avoided that. I'm sure they want to see what the monthly inflation number will be as well. And after that, we can get a little bit more specifics in commentary. We had some other officials saying that, well, if jobs remain as they are, we might have to do more, but nothing really that indicated people have substantially reevaluated their outlook on monetary policy. Nothing like what we had last June, for example, when there was kind of like this aha moment for the Fed where they got together and said, it's time to wrap it up, and it's time to wrap it up really quickly. So we will see. And if inflation does remain strong, I should say if next week the number comes stronger than what people expect, I think Chair Powell will have an opportunity at the end of the month when he appears in front of Congress for his semi-annual testimony to kind of slot that in and basically hint that, listen, we have forecasts coming up in March. We probably will nudge them a little bit higher, or it is likely that we could see a higher terminal rate based on what the data has been showing so far. And as far as inflation goes next week, I'll quickly kind of point out that we do expect a relatively firm read at 0.3 in core, which is just below market pricing right now. But it still remains at a level that is elevated and should, it should keep the Fed on their toes.
Yeah, all eyes on inflation next week then.
Yeah. Well, I guess that's kind of enough for the U.S. for now. And switching a little bit to the U.K., we spoke a little bit at NFPs, and of course that was a very, very strong number. We had BOE last week too, not just the Fed, and combination of the British Central Bank and data from globally, I should say, that was pretty strong. Where has that left the market, and maybe even more importantly, your views?
What's more importantly, yeah. I mean, we've kind of been through the background of the market reaction over the last couple of days, but I guess just to go back to the post-BOE market reaction, because I think we probably spoke on this podcast at the time last week and said that it felt like the market reaction was a little bit overdone. And actually, once we'd got back to our desks and by the time the close of that day, we'd followed through on that much more strongly. So by that point, it really felt like the market reaction was overdone, although the BOE was dovish, and it was more dovish than we were expecting and the market was expecting. It wasn't like they just announced QE or even like they'd announced rate cuts, and nothing of the sort. So it did feel like the market reaction was telling in that it felt like perhaps that was a change in perception of the market skew of risks around the inflation outlook. Now, obviously, we've given a lot of that back since NFPs, and perhaps that's brought, a bit of a risk, to the other side now in terms of the inflation outlook. But against that backdrop, and also against the backdrop of everything that we've talked about over the last couple of weeks on this podcast with regards to the potential downside risks to supply stemming from the DMO or Treasury relying on diversified funding risks, and perhaps some upside risks to demand, if the market becomes more comfortable as central banks are getting more comfortable that we've kind of turned a corner in inflation, that might see a pickup in demand for duration in general, but perhaps also UK assets. I think all of that together has led us to slightly revise down our 10-year gilt target. So we're still very bearish. We're still much more bearish than the market, than the forwards are pricing in. But we're just looking now for a 10-year gilts in the middle of this year to get to 375 versus previously 4.1. So it's not kind of a complete change in the narrative, and it's certainly not really a change of the drivers of that bearish outlook. But it did feel like the market reaction last week that kind of followed through on Friday morning up until payrolls was pretty telling in terms of the way that, the market was starting to think about inflationary risks.
Yeah, and you mentioned your 10-year target, but how about the curve this week and or generally your outlook? Because gilts have been underperforming this week, but it hasn't really been particularly the 10-year point, but the front end has been driving down the performance. What has been the catalyst behind that?
Yeah, that's been a little bit frustrating actually, because although we have this kind of bearish 10-year view, I think that comes about with the curve steepening, particularly that kind of 2s/10s part of the curve where that's currently inverted. I think that can reinvert. So although the underperformance hasn't been that frustrating, the fact that it's kind of brought about a curve flattener in that front end has been a little bit frustrating. I think there's a couple of reasons. And I guess, first of all, I would focus on the supply risks for general cross-market underperformance of gilts. I mean, perhaps it's not surprising. They've outperformed kind of consistently over the last couple of weeks, but certainly last week after the central bank. So perhaps they were due to give a little bit of that back anyway. And like I say, the market reaction was a bit overdone. But we have had a relatively heavy supply week this week. We've had the DMO come twice and the Bank of England come twice. And perhaps there was just a little bit of kind of, supply saturation in there that the market, a bit of supply fatigue, perhaps even that was causing this underperformance. And I think that's important when we think about the supply risks down the line, because, I've been flagging for so long that the DMO coming a couple of times a week and the Bank of England coming a couple of times a week, it's going to start to feel normal from April onwards once we get into the new fiscal year. And I think that, the takeaway for me, especially when you look at today's Bank of England auction, so Thursday today, the short end auction, which has caused even further underperformance at the front end of the curve, given that was, well, sort of technically uncovered is the language that's being using, although that's not 100% what really was the case, because there were more bids than the 750 million that the Bank of England wanted to sell. They just didn't want to sell them at that price. So that's caused a bit of a knee-jerk underperformance in the front end of the curve as well, as that's the first QT auction that we've had that has been, uncovered, if we want to use that word. If you remember at the beginning of this year when they were doing financial stability sales at the long end, those auctions were being taken down, very well, surprisingly well, I would have said. And in fact, all of the smaller regular QT auctions that we've had so far, demand has been on average about 2 times more than what the Bank of England have been wanting to sell. So it was interesting to me that in a week where we've had kind of consistent auctions, actually the last one of the week didn't go so well. And perhaps that's indicative of the kind of supply fatigue that's to come. And if the market's going to take down all of this additional supply, the clearing price needs to shift. Now, I don't think it's all negative kind of, the takeaways from today's auction that's led to that front end underperformance. I think that there's, I think it's a positive in the sense that perhaps this means that the bank isn't as price insensitive as we thought they were. They're rejecting bids. They're not selling 650 million in every auction at all costs. So I don't think it's as obvious as just saying this is a clear risk for gilts and this is going to continue now. But I do think that there's perhaps takeaways for how the market's going to trade, around these supply events in the next fiscal year. I guess the other final point that I'd make around front-end underperformance is, like everywhere, we've had a bit of hawkish commentary this week. We've had Catherine Mann on the wires on Monday. We've had the Treasury Select Committee today. I don't think anything really changes the messaging from what the Bank of England told us last week. I think the messaging last week was pretty clear that they think that we're close to a peak. And, the data will guide what their next steps are. But they clearly told us that in their view, the risks were skewed quite significantly to the upside on inflation, and that would likely necessitate more hikes. But I just think perhaps both Catherine Mann, who's a well-known hawk anyway, but certainly today in the Treasury Select Committee, they were really emphasizing those upside risks to inflation again, which I think the market was kind of choosing to skim over a little bit in its post-BOE reaction function last week. The only dove that we had really on the council today, in front of the Treasury Select Committee, was Tenraro, who, is known to be the leading dove on the committee anyway. And I think it's just worth mentioning that she, although she made a lot of comments around thinking about when the timing might be for cutting rates, she's actually due to roll off. Her second term ends in the summer of this year. So June will be the last meeting at which she casts a vote. And so, perhaps that also at the margin gives the committee a bit of a hawkish skew going forwards.
Okay, well, we will have some very important data from the UK next week too. So do you just want to give us a rundown on what we should expect and what are the key things to look out for?
Yeah, I guess, markets now, I think the key message from last week is that central banks are moving away from this period of forward guidance that we've known for so long, both through the kind of low for longer era, but then also through this kind of rates are going significantly higher era in a post-COVID world, to now being much more data dependent. which means that, as we have seen already, every data point and every central bank speak gets, a lot more focus and a lot more attention than perhaps it warrants or normally does. So that does leave next week's data as pretty important. It's the big data week anyway in the UK. We'll get inflation, labour market data, and retail sales. Obviously slightly overshadowed a little bit by US inflation, but it's important for us UK watchers nonetheless. Obviously inflation is the Bank of England's target, but I think actually this week it might be the labour market data that's more key, given that that's really what the Bank of England's watching in terms of second round effects and to judge the persistence of inflationary pressures, I suppose. So I think it's well understood now that the peak is probably in the inflation profile. It's well understood that inflation will come down this year. It's just a question mark of how quickly. And the key to how quickly it comes down lies in the UK within the labour market. So we'll be watching that most closely. Retail sales obviously important too, but it's inflation and the labour market data that is still sending strong inflationary signals rather than, all the other things. We've been looking at a kind of dashboard of indicators that the Bank of England might be watching, and most other things are flashing kind of disinflationary compared to previous cycles, previous cutting cycles, that is. It's only really the labour market that's still running very hot, and obviously inflation as well. So that's what we'll be watching most closely next week, and I'm sure the market will too in this kind of data-dependent world. But anyway, that's enough on the UK. Let's switch over to Europe. Joann, obviously, given everything we've already said, it's been a big week in Europe too, following the ECB and the NFPs. What's, I guess, been the ECB's take since the meeting last week? Is there any sort of updated guidance that's mattered?
Yeah, so we had quite a big rally last week after the ECB, like the rest of the world, really. Anything that was less than the super hawkish Lagarde from December was really interpreted by the markets as being a bit more dovish. And then the NFPs kind of retraced that a little bit the day after. But I think what's been really interesting since the meeting has really been the ECB hawks, who do seem quite dissatisfied with the way in which markets have taken in the message from Thursday's meeting. We've got quite a lot of pushback there from the hawks, saying that March does not necessarily mark the end for ECB rate hikes. We saw Schnabel this week and Klaus Knott as well kind of confirm this message. And it's pretty obvious what the hawks are worried about, and it's inflation. Just before I kind of expand on what the hawks think, we did get this German CPI number this morning, which, to remind you, last week we didn't have when the Euro area CPI print was released. And this kind of print did confirm the story that even though it was higher than expected, higher than the Eurostat number last week, it did kind of confirm the story that Euro area inflation is coming down. And headline inflation really is coming down. But I think what the hawks are more worried about, of course, is core inflation, which has been a bit stickier. And secondly, of course, wage inflation. The argument being that wage expectations are higher and that bargaining power as well is sad because of the cost incurred of the last year. So that's kind of what the hawks are worried about. But to put that into perspective, the Euro area wage inflation data indicates that wage inflation is around 3% in the Euro area. So not quite wage spiral worthy just of yet. I do think what will be important for the next meeting really is the forecasts for inflation coming up.
Okay, so thinking about that next meeting then, has anything over the last week kind of changed your view on their policy stance? I know when we spoke last week with Giles, he talked about the fact that you were revising up your forecast for the deposit rate. Is that revised up view still holding, or have you kind of changed how hawkishly you think the ECB might react going forwards? And perhaps you can just remind our listeners what that revised up view is as well.
Yeah, so we've upgraded our terminal rate forecast now from 3% to 3.25%, just on the basis of the ECB meeting last week and them kind of emphasizing that they're staying the course. So we do think it's going to be a 50 basis point hike in March and then a 25 basis point hike in May. So the hawks haven't really changed our perspective on this, really. We think, obviously, the hawks are being hawks and talking up inflation. But like I said, I think the inflation forecast that the ECB used last time around really was a bit outdated. We've had more than 60 basis points, around 60 basis points in hikes added in since December. And energy prices have also come down quite a lot. So there's a lot more information for the ECB to have to really incorporate into their forecasts. I think secondly, we've also really got to think about monetary policy lags and how that impacts kind of rates going forward. And as well as that, I do think kind of 3 to 3.25% for us does seem more in line with a soft landing, which I think that the ECB should really try and navigate given what we're seeing in the macro backdrop. So inflation coming down with growth data really kind of staying quite resilient for now. So a soft landing scenario where they get to 3 to 3.25% is what we really think the ECB should be aiming for. Markets are pricing in more like 3.4% to 3.5% at the moment, with some rate cuts at the end of this year. And to me, that really does signal some kind of policy error by the ECB, which I do think they will be quite keen to avoid. But obviously, we're really watching March's meeting to understand what they're seeing in the forecast and how they are seeing things going forward.
Yeah, I think that lag transmission mechanism of monetary policy is important. That's something that we've been talking about a lot in the UK as well. And disregarding that risks over tightening really in this macro backdrop. Okay, sticking with the ECB then, but a little bit off topic. And it's disappointing that Giles isn't here this week because this is surely his favorite topic. But they kind of surprised markets this week with their announcement on the remuneration of government deposits. We knew that an announcement was coming, but kind of thought that would be closer to the end of April. How did that square with expectations then, despite the fact that it came much earlier than expected? And how does that leave your view on swap spreads going forwards?
Yeah, so it was a bit of a surprise with the announcement this week. I do think that some of the widening we've seen in swap spreads over the last kind of few weeks really has been about some nervousness in markets that the ECB will kind of take this out completely and push the remuneration rate right back down to 0%. So to some extent, this kind of shaving was a positive surprise, and we did see asset swaps tighten a bit as a result. For us, we do think that adjustment does put asset swaps, at least for now, at fair. In the short term, there are obviously some things we think that could lead to widening pressures. For example, lots of supply coming, which could be swapped. But I think kind of longer term tactically, what we think for swap spread is that they will tighten. Kind of a similar story to what we've said previously, but on the tightening story, really, where lots of the things we saw last year, like collateral scarcity, is likely to be coming to an end because of this like big surge in supply we have this year, as well as QT as well.
Okay, great. All right, let's wrap it up there then this week. Thank you both for joining me, and thank you to our listeners for listening in as well. And just a reminder that if you like today's episode, please don't forget to hit the like button and click subscribe so you get the latest episodes as soon as they're available. Thanks. See you next week.